Hey everyone, welcome back to Tech Finance. So we need to talk about the Fed because the Fed could literally destroy the market. Well, you might be watching this tomorrow, so I should just say on Wednesday, March 17th, which is 1 year to the date, almost the bottom of the market, March 23rd of 2020, when the market was totally in the big old doldrums and things weren't pretty good on March 17th last year either. Okay, because March 16th was one heck of a sell-off, but the point is, the Federal Reserve could do some serious damage to markets tomorrow. And I'm not happy about it. I'm not very enthusiastic. There's a reason why I have not sent a single freaking buy alert. No, I'm just kidding. So I did some investing in Bitcoin, though I'll show it to you later on another video. And so it's probably gonna be pretty nasty. So in 7 days now, so you have people like Meet Kevin, who just said yesterday they didn't do a single buy for like 7 days, which is coming from him is huge. So the Fed could be pretty nasty. There are two big catalysts that we're looking for tomorrow. All right, so let me first explain details here as well. The Federal Reserve Chairman Jerome Powell will be speaking at 2:30 p.m. on a March 17th, and he will be discussing the outcome of the two-day policy meeting, the FOMC Open Market Committee, they'll be discussing the results of those. Federal Reserve Chairman Jerome Powell will give a prepared statement, and then we will answer questions for about 45 minutes with Jerome Powell. Jerome Powell will give a prepared statement, like we said, and he will answer questions for about 45 minutes. What Jerome Powell says or does not say during this discussion and initial speech will not only be picked apart word for word, but could make or break the market tomorrow. The market's already very tenuous, and we saw that today here on the 16th. We saw a lot of tenuousness in stocks, and I mean, we had a good open, but after the first hour here on Tuesday, the market just started setting off because it's like, wait a minute, tomorrow's Fed day. It's almost like the suits woke up and they're like, oh yes, stocks are doing good. Jerome Powell speaking tomorrow. Oh shit, everything, like seriously. Like it used to be, don't fight the Fed. Jerome Powell, the savior, is coming out to speak. Now it's bad. It's all bad because of what happened last time around. And that was when Jerome Powell spoke a couple of Thursdays ago on an interview, and he was asked, hey, bond yields just skyrocketed. They shot up at the fastest velocity we have seen bond yields go up in over 10 years. What are you going to do about it, Mr. Powell? And remember, the stock market's like, dude, you've been here for us every day so far. You keep bailing us out. What are you going to do this time to bail us out again? We're worried about inflation coming. Like, please calm down our fears of this inflation coming. And Jerome Powell's like, everything appears to be operating normally here. We want inflation. We're trying to get interest rates up. We're trying to get rates to 2%. We're trying to get inflation to 2.5%. We're not planning on doing anything now, but I mean, look, bond yields are going up because they think there's going to be inflation. Cool, sweet. I write that off my list. Success. And the stock market lost it completely. We had the bloodiest Thursday and Friday in this crash that we had over last month. So because of Jerome Powell. Now, obviously, we could say we've had the greatest run in over a year because of Powell and the money printer. But what Jerome Powell says or does not say tomorrow is going to potentially amplify in either direction. What happens now, I have expectations. We'll talk about those expectations. But let's make the two catalysts very simple. Catalyst number one is Jerome Powell making a statement about anything that could affect yields. If Jerome Powell says, hey, standard leverage ratio or standard liquidity ratio over the banks, we'll go ahead and extend that. We'll let the banks have less money on hand, and, we'll just extend the CARES Act program that expires at the end of this month, which lets banks have less cash on hand so that they have more money for potential losses or issues that come up. If Fed Chairman Jerome Powell says, hey, we're cool with you having less cash on hand, that means banks could potentially buy more bond yields, come down, markets happy, interests are going down. And if we see any kind of yield curve where the Fed says, we're going to start buying some longer term bonds, and we're going to buy, instead of maybe 10 years, we're going to buy some 20, 30 yields. bond yields. That has the effect of pushing down long-term rates, which is a form of curve control. The market is going to cheer that. The market is going to cheer anything that implies additional liquidity or lower rates. That will be very, very good for the stock market. It certainly will be very good for tech stocks. Unfortunately, I don't think that's going to happen. Now, there's a second catalyst, but let me finish the thought here on catalyst number one and give my opinion on it. On catalyst number one, I don't expect catalyst number one to happen going any differently from what we had 2 weeks ago. And that was Fed Chair Jerome Powell going, look, money is flowing, markets are working. If yields are going up, we don't see a problem with that. Or if yields are going up, we don't see a problem with that. In fact, if you think inflation is getting out of hand or something, we'll do something about that. But we don't think there's going to be inflation. We think there's going to have temporary spikes due to base effects comparing to a year ago, and temporary spikes due to reopening. But we think those will be transitory in nature. They'll say, we don't see persistent inflation happening. We think money markets and, liquidity is operating as intended. We don't think the banks need to have these low reserves anymore because they're writing off less losses. I mean, this was something I discovered all eyes look. On the document in front of me in the Wall Street Journal, it's this on the page of the Wall Street Journal, come on Volksbank. Banks, high cash reserves for profit. US banks are sitting on a pile of cash that could turn into billions of dollars of profits. You think Jerome Powell is waking up on Tuesday going, banks need help? No. My expectation is not good for tomorrow, when Chairman Jerome Powell talks, because Chair Powell is not going to give the market what the market wants. The market wants some more cheap. Want some more money. Let's go. Come on. Just one more hit. Come on, one more hit. So the market wants. The market's not going to get it tomorrow. And that's why we started sending off today. I really believe that Fed Chair Jerome Powell is literally going to do nothing. He's going to let this bank thing expire. He might not even address it. I think he's going to get asked about it. And if he gets asked about it, I wouldn't be surprised if he just blows it off and says, we haven't determined yet. That's going to be a blow off. It's going to be like March 30th and they're just going to let it expire. I wouldn't be shocked. They'll just kind of let this bond thing play out and then they'll just let that bank expire. It wouldn't shock me whatsoever. I mean, that's what, if I were Chair Jerome Powell reading this stuff in the Wall Street Journal and probably doing research to reiterate the same thing. And it's true. Banks didn't lose as much money as they thought would lose. So they got plenty more cash. They set us a bunch of money aside for a rainy day and they didn't need it. So I don't think banks are going to be happy. I think everybody's kind of expecting that. I don't think they're going to institute any kind of yield curve controls because what is happening with bond yields going up is literally what the Fed wants. They want this. This is good for them. And the auctions are going fine. There was a panic initially with how quickly the yields went up, but the auctions are going fine now. There's enough balance. The supply and demand is right. The Fed doesn't have to change anything. So not expecting change. It's just going to be bad for tech and maybe a buying opportunity again. This second catalyst, okay. This is potentially a bigger one because we already have this strong expectation from the last time Jerome spoke that nothing's going to happen. Okay, so what's the second possible thing? What else could Fed chairs screw up on tomorrow? I don't want to come across too blunt, but I have something called the Summary of Economic Projections, the SCP. Notice what it says for release at 2 p.m. Eastern this time, December 16th, 2020. This is what the Fed does. They release these. They have these documents embargoed until exactly 2 p.m. Well, we got one coming up tomorrow, which you might be watching this on the 17th. So today at 2 p.m. Eastern time, it's the same thing as they are on time. These people are sharp. This is not like Biden or Trump taking 30 minutes to show up for the speeches. Both of them are late all the freaking time to their events. This stuff shows up on time. They're on point, and there are two very important pages that we have to look at. Page of importance number 1 is the change between the last summary of economic projections and the next one. So, for example, what we're looking for is any kind of change that could signal the Fed is interested in moving rates higher. Let's go ahead and just erase all this. Actually, I'll erase it. All of this thing here. Let's do so. The summary of economic projections here. from December indicates that the Fed believes we will have GDP growth of 4.2% and that we will end up in 2024 plus with 1.8 growth if the Fed increases their projection. If this number goes up, then it's possible the Fed's thinking, oh, the economy is doing much better than expected, which is something I do think the Fed is going to do. And that number goes to 4.5 or 5 even, or 6%. People are going to perceive that as, oh, Fed thinks growth is coming back faster. That means they're going to increase interest rates faster. It's that simple. Market's going to sell off. It already is because of this expectation. If the unemployment rate is expected to be below 5 in 2021, it's going to change expectations completely. I think the market might sell off, especially to attack again. If we see the unemployment rate in 2022 go under 4%, you better believe when that unemployment rate goes under 4%, people are going to think that that's it, the Fed raising interest sooner and tapering. Remember, there are two things the Fed could begin doing: tapering their bond purchases sooner, and then they'll eventually raise rates in the stock market. Doesn't like the idea of that, even though this is all a bunch of bull crap, short-term crap thinking. It's not like I want to sell out the market, not be in the market, not be participating in buying the dip in the market just because, over time yields are going to go up again and interest rates are going to go up again. I don't care, bring it on. People are still going to invest. Buying the dip is really good. And so anyway, inflation going up, GDP going up, the unemployment rate going up, and certainly inflation expectations, which the Fed's measure is PCE here. In these figures here, we see interest rates are going to go up. So this is a very, 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 very certainly over here, but we're not going to see any change down there. So I think that's it for today. We're not going to go any further than that. I promised you an inflation video, and I think this is it. So this is how actually the Fed is going to be. It's going to be very risky how Jerome Powell speaks today. It's either going to crash the market, or if by a miracle he says something good, it's going to get better. So hope you enjoyed the video. If you did, hit the like button, subscribe to the channel if you haven't already, and hope to see you guys next time.